Welcome to this Premier training video, which reviews cash books and bank reconciliations. During the session, we will be looking at the purpose of the cash book. So what is it used for and what benefits does it have to the business? We'll also be looking at why a bank reconciliation is required, who performs it, and again, why. And then lastly, we'll have a look at reasons for differences between the cash book and the bank statement. And all this process does is helps the business understand the timing differences between the two financial documents.
So what actually is the cash book? Well, the cash book is a book of prime entry which is maintained by the business and helps them manage their cash position. It's updated on a regular basis by their finance team. The frequency of this update will really depend upon the business themselves. For some businesses, a monthly basis will be appropriate, but for those businesses with a high volume of transactions, they may consider to prefer a daily or a weekly process to review the cash book. The cash book is an essential tool when a business is looking to maintain its liquidity. And when we talk about liquidity, we're really talking about the solvency of the business, the working capital of the business. In other words, does a business have sufficient assets, current assets, to pay their liabilities? Throughout your studies, you will become exposed to various layouts in terms of the cash book. The important thing to remember is that regardless of the format, the purpose of the cash book, the book of prime entry, remains the same, and that is to capture the financial transactions of the business. The layout that you see in front of you is generally considered to be the traditional format for the cash book, with money in on the debit side and money out on the credit side. Transactions that appear on the debit side of the cash book will increase the asset balance, and those on the credit side will reduce it. Often learners think about this format as two separate ledger accounts captured in one book, and that is of the cash and the bank. By reviewing this cash book, we can see at any given point the amount of cash available and the amount of money that the business believes it has in terms of its bank balance. A different form of cash book is the analysed cash book. And the purpose remains the same, exactly as the one on the previous slide. It enables us to monitor our cash and monetary movements. But what we're doing is we're analysing out those monetary movements to give our finance team a little bit more information. The top table is considered the debit side of the cash book receipts, and the bottom, the credit side, the cash book payments. And they do exactly as their name suggests. They capture money in, they capture money out. If we firstly look at the top table, the cash book receipts, we can see on the left hand side of your screen, you've got your date, your details, your cash and your bank. And that's very similar to the layout that you'd have seen previously. But extending that information now, we've got what we call our analysis columns. And these analysis columns are very much interchangeable, dependent upon the needs and requirements of your business. In this particular activity, we can see we've got a column for VAT, for cash sales, for the receivables ledger control account, and then a sundry column. Basically what we're doing here is when we make an entry into either the cash or the bank column, we will then analyse that to show where exactly that money has come from. If it was a cash sale, then the VAT and the cash sales figures would be populated. If we'd received money from a receivable, that money would come into the debit side, the cash book receipts. It would be recorded perhaps in the bank column if it was received by bank transfer, and that amount would also appear in the receivables ledger control account. The sundry column is obviously optional, and for some businesses that may be a different column heading there. Sundry column could represent maybe rent received or commission received, obviously very relevant and personal to your individual business. If we look at the second table, we're now looking at what the credit side of the cash book looks like in terms of being analysed, and this is the cash book payments. Just as before, we have details of our date, details, cash and bank, and this represents money out of our business. But again, what we're trying to do is understand where that money is going to. We've got a VAT column a cash purchases column, a payables ledger control column for when we pay our credit suppliers, and another expenses column, maybe for when we pay rent or cleaning or stationery expenses. The idea of the analysed cash book is just to enable us to understand a little bit more about where our money is going, and it can also help in terms of future planning because it can help a business look at the timing of receipts and the timing of payments, and that can help manage the cash position and ultimately the liquidity of the business. When we have a cash book, we have to consider how the opening balances would be recognised. We will have an opening balance for cash, and we will also have an opening balance for bank. In the format that you can see in front of you, you can see that we have at the 1st of April a balance brought down, an opening balance at the bank of £5,000. This is recognised on the credit side of our cash book, which means that we have a liability to our financial provider. We are overdrawn. Hopefully this overdraft facility has been arranged in advance, showing that we're proactive and we're managing our cash position effectively. But when we're dealing with a cash book, we should also have an opening balance for the cash. And in this question, we have a balance brought down at the 1st of April of £250. And that's an asset to the business. And that's a physical asset that we should physically be able to go somewhere in our business and count and agree to that figure. So having looked at the various layouts that we may come across in terms of the cash book, we now should also consider what the actual entries into the cash book may look like. We start with our opening balances and we're comfortable with what those represent. So we've got £250 on the debit side for the cash, showing an asset, and we have an overdrawn bank balance of £5,000 showing a liability on the credit side. But throughout the accounting period, businesses will encounter various other transactions, and the cash book is what captures these monetary movements. Remembering those transactions on the debit side represent money coming into the business, those on the credit represent money leaving the business, payments. So on the 2nd of April, we have sales of £400 going directly into the bank. And that transaction indicates it's a cash transaction. We're not given any further information, so it indicates that the sale took place and funds were received immediately. On the 3rd of April, on the credit side of the cash book, we're showing that we've paid wages of £500. That's money leaving the bank. On the 4th of April, Bradley Limited has paid us £4,200. Now, on the basis we have very limited information concerning this business, what that tends to indicate is that is payment received from a receivable. Because if this was a cash transaction, a cash sale, then we would literally be seeing the word sales or cash sales there. Remembering that the word cash sales doesn't mean cash, it just means the instant nature of the transaction. But as we can see Bradley Limited there, what that indicates is a customer has paid us, a receivable has settled their account. On the 5th of April, we appear to have more sales, and these tend to be of a cash nature this time because we don't know the name of the receivable or the entity that the money came from, and that's £1,200. On the 8th of April, we've made a payment, and we know it's a payment because it's on the credit side of our cash book, of £1,100, and that's to Wood and Sons. And what that indicates is that we've made a payment to a payable, because again, if this was a cash purchase, we wouldn't be given the name of the company, we would simply have details of purchases. On the 14th of April, a further payment of £800, this time relating to rent. On the 24th of April, we have some more sales, and this time it's cash that's being received, so it's in the cash column, and that's £120. So as we can see, this is quite a simple business, not a fantastic amount of volume in terms of transactions, but it just gives you an idea of the type of transactions and how they would be recognised in the cash book itself. Remembering those transactions on the debit side represents money in, and those on the credit, money out. Of course, at the end of the period, what is really going to be of interest to us is what our closing balances are going to be looking like. And therefore now we need to look at what happens when we balance off a cash book at the end of the period. So having looked at the transactions that occur on a regular basis, what we need to do at the period end is complete and balance off that cash book. And we're going to use 5 steps to help us do that. Steps are really important when it comes to accountancy and bookkeeping, because with steps it provides structure, with structure we have confidence, and with confidence we secure marks in our assessment. So the 5 steps we're going to look at. The first one is we're going to add up the debit and the credit side of both the cash and the bank columns. So we'll have a little subtotal somewhere on a scrap piece of paper or just to the side of our cash book that tells us what the debit and credit balances are for the cash columns and what the debit and credit balances are for the bank columns. Having established these amounts, we will then find the difference between the two. We'll find the difference between the debit and credit side of both cash and bank columns. With this difference, we will place it on the smallest side of the cash and the bank column. And this will have a narrative of balance carried down, balance CD. And this completes the cash book for the period. Generally, unless the question tells us otherwise, this will generally have a date at the end of your period, so the 30th, the 31st of the month. Sometimes be careful because this can be different depending upon the instructions of the question. We're fanatics in accounts and bookkeeping about totals and making sure they agree. So having successfully completed step 3, we then, as part of step 4, insert totals into the cash book. And by inserting these totals, both the debit and credit side of the cash book for both cash and bank columns should agree. It's almost a check that mathematically we have completed the previous steps correctly. And then the final step to conclude the balancing off of the cash book is to insert the balance brought down on the opposite side of the cash book to the balance carried down. And this basically tells us what we're starting our next period with, the balance brought down, the balance BD. Generally, this will be the next available date following on from the balance carried down date. We've looked at those 5 steps, but it's far easier to actually see them in practice. So let's show you now step 1 and step 2. This is the cash book that we've previously reviewed, and we've looked at the entries and we've understood why transactions appear on the debit side and why transactions are on the credit. Let's do step 1. Step 1 says that we add up the debit and the credit side for the cash and the bank columns. So let's get some subtotals. Looking at the cash first. So the debit side of the cash book for the cash column agrees to £370. And there is nothing on the credit side of the cash book relating to that cash column. We'll revisit this when we do step 2, but now let's turn our attention to the bank column. The debit side of the cash book for bank is 5,800 and the credit side is 7,400. Instantly when we look at that, we can see that our payments are greater than our receipts, and what that means is that we've paid out more than we've received, and that's something we may need to be mindful of when it comes to steps 3 and 4. Now let's look at step 2. Steps 2 is finding that difference between the debit and the credit side. So we've got our balances, and for cash the difference is 370 because there's nothing on the credit side, so that was relatively straightforward. For the bank, well, the difference is 1,600. So our 7,400, take away our 5,800, gives me 1,600, 1,600. And these are the balances that will now represent our balance carried down and our balance brought down. We've completed steps 1 and step 2. We found our totals, we found the difference. Step 3 is to put that difference on the smallest side of both the cash and the bank columns, and that will be recognised as our balance carried down. So let's just remind ourselves of what those balances were. For cash, we had a difference of 370, and step 3 states that we put this difference on the smallest side of the cash column. Well, that's really straightforward because there's nothing on the credit side. So as at the 30th of April, remembering we usually do it at the end of the period unless the question tells us otherwise, as at the 30th of April, our balance carried down is £370, and that's put on the credit side because that's the smallest side of the debit and credit side of the cash columns. Repeating that process for the bank, well, we established the difference was 1600, and we must remember to place it on the smallest side. Now, instantly when we see our little table, we can see that's the debit side, and therefore the balance carried down for bank will appear on the debit side of the account, as at the period end, the 30th of April, with a narrative of balance carried down. That's step 3. Step 4 is to insert totals. So this is our mathematical check that what we've done is correct, and I would always encourage you to just get that calculator out and re-add up the figures. It's a couple of minutes to do, but actually could safeguard against silly errors which we're all capable of doing. When you insert the totals, they should be parallel to each other, and the fundamental point here is they have to agree. At the end of the period, it says that we have £370 of cash in our business, and we believe that potentially we have a balance of 1,600, and because that balance carried down has been placed on the credit side, that indicates that that is potentially a liability, and we'll discuss that further when we look at step 5. The final stage is to insert the balance brought down in the cash book, and we're going to use what we've previously done to help us complete this step. We can see that at the 30th of April we had a balance carried down for both bank and cash, and the final step is to transfer these balance carried down figures to the opposite side of the cash book. So for bank, we had a balance carried down of 1600 on the debit side of the cash book. This transfers to the credit side of the cash book on the next available date, which is the 1st of May, as the balance brought down. This is a liability to our business, and we can see that because the bank figure is on the credit side. This means that we must be overdrawn. Hopefully, that overdraft facility is in place because we've been proactive in managing our cash position. We also need to complete the process for the cash balance, and we can see that as at the 30th of April we had a balance carried down of £370, which means at the 1st of May, on the opposite side of the cash book, we're going to recognise a balance brought down of £370. And somewhere in our business we should be able to go to a cash tin, hopefully in a secure place, and check and verify that figure is correct. So far in our presentation, we've focused our efforts on the cash book, the purpose of the cash book, entries into the cash book, and balancing that cash book off at the period end. The next step is to consider what the bank considers our balances to be, and this will be verified by looking at our bank statement. The bank statement is issued to the business from their financial provider, and again will list information concerning monetary movements for a particular period. This can be done on a weekly, daily, monthly basis, depending upon the demands of your business, and as previously stated, that really will be dictated to by the volume of transactions a business incurs. If you consider a large supermarket, retail store that has a high volume of transactions, doing a monthly reconciliation would be a minefield because there'd just be too many. So they may decide to do their bank reconciliation statements more frequently. Most financial providers will enable their business to download a daily electronical file that enables them to see access to their business accounts, a little bit like what we can do when we log on to our online banking account from a personal perspective. The bank statement is an invaluable tool when we look to monitor the cash position of the business. The reconciliation between our records and the bank's is imperative. It helps us identify any abnormal transactions, so transactions that we're not expecting. And again, this is something we do from a personal point of view. We would have a look through our transactions to make sure that all of those we're familiar and we're comfortable with. Also, keeping a close eye on your bank statements and your cash position will also enable us to identify any periods of surplus, or in what we've seen so far in our presentation is where we've had a cash deficit because our bank balance has been overdrawn. And in those instances, it's been important because that would help us identify the requirement and the need for a bank overdraft. The bank reconciliation process acts as a deterrent against fraud. As the bank statement is an independent record, it helps us verify the cashbook balance. Because the bank statement is prepared by the financial provider and the cashbook is prepared by the business, these are maintained by different sources, so a comparison of the two is seen as a really useful control activity in helping highlight any unusual or abnormal transactions. Of course, there will always be differences between the cashbook and the bank statement, and the purpose of the reconciliation is not to remove or eradicate these differences, it's to help the business understand timing differences. And as we progress through the remainder of this presentation, we will see that the timing differences we're referring to are outstanding lodgements and unpresented cheques. When you first start to learn double entry, the world of debits and credits can seem quite confusing and almost illogical in terms of your previous knowledge. Now, that previous knowledge may be based on your bank statement from a personal point of view, and everything perhaps seems a little bit backwards. If we have a credit balance on our bank statement, the bank classifies this as money that it owes to the customer. And consequently, this credit balance is recognised from the bank's perspective as a liability, money that they owe to us. So when we have a credit balance as the opening balance on our bank statement, this is money in the bank. Whereas we know if we have a credit balance in our cash book, it represents a liability because we owe money to the bank. The reason that there's a slight difference between the two is it's who is preparing the document. So in the bank statements case, the bank are preparing the document, and consequently, if we deposit money with them, they owe it to us as their customer, and that is treated as a credit because it's a liability. Equally so, if the bank account is overdrawn, when the bank prepare that bank statement, they will show this as a debit balance because the bank classifies the customer to be a receivable at this point, and therefore they recognise this as an asset because their customer owes them money because they're overdrawn. So the theory behind debits and credits remains unchanged. Debits are assets, credits are liabilities, but why it's different is because of who has actually prepared the document. So far, we've looked at the cash book, we've considered entries into the cash book, and we've balanced off the cash book. And that is our business's record of the monetary movements that we are aware of. But it's also important to consider those transactions that we may not necessarily have visibility of until they actually hit the bank. And consequently, it's recommended that a bank reconciliation is prepared on a frequent basis. For most businesses, that will certainly be a monthly basis, but the frequency will obviously depend upon the nature of the business and the volume of transactions. The process is quite straightforward, but in essence, what we're trying to do is we're trying to look at the bank column of the cash book and check it to the bank statement. The cash book is our records, and we're cross-referencing those to our financial providers. The bank column of the cash book and the bank statement probably won't agree, and there's various reasons for that. And the whole idea behind the bank reconciliation is not to eradicate the differences, but it's to reconcile them and understand them. So how we complete the bank reconciliation requires a methodical approach, and I'm going to introduce you to 5 steps. Step 1 is we agree the opening balances. We agree the opening balances from the cash book and the bank statement. Often this step is overlooked, and this will cause you problems if you fail to do it. So remember, step 1 is key. Agree those opening balances. Does the opening balance on the cash book and the bank statement, do they agree? And if they don't, we need to go and make sure that they do before we proceed. Step 2 is our ticking back exercise. We will cross-reference those items that appear both on the cash book and the bank statement, and it's perhaps useful to have a highlighter to hand there. Step 3 is those items that are not in the cash book but are on the bank statement should be updated into the cash book. So these could be transactions that maybe we're aware of in terms of their timing, but we may not necessarily be aware of the amount until they actually hit our account. And a common one for that perhaps could be a mobile phone bill. You may pay a monthly contract, but if you exceed usage, then obviously that would be something that you wouldn't be aware of until it actually hit. Another one could be bank charges or any interest. The first time we have visibility of those transactions would be when we review our bank statement. Step 4 is we will balance off the cash book to establish the new balance carried down, taking into account those items that we've updated into the cash book from the bank statement. And then, and only then, are we ready to complete the bank reconciliation. And those unticked items that are on the cash book will form our bank reconciliation process, and they are ultimately our timing differences. They are the reasons for the difference. I've used that word a couple of times throughout this presentation, timing differences. In essence, there is two, an unpresented cheque and an outstanding lodgement. An unpresented cheque are payments which appear on the credit side of the cash book, but they've not yet cleared the bank, perhaps because they haven't been taken to the bank, or perhaps just because they haven't been recognised as such. These will be in our cash book on the credit side, but they have not yet cleared the bank. They're not yet in our bank's records. Outstanding lodgements, a very similar principle, but these appear on the debit side of the cash book. They've not yet cleared the bank. So these are receipts that have come into our business, we've recorded them into our cash book, but again, not yet through the bank's financial system. When we have timing differences, there's no adjustments to be made. We don't take out those presented cheques or outstanding lodgements. We do no adjustments. We simply recognise them on the face of the bank reconciliation, and those timing differences will help us reconcile the balances on the cash book and the bank statement. We've talked about the 5 steps for the bank reconciliation process, but it's far easier to actually see them in practice. So we work at Bradley Enterprises, and we've been asked to review the cash book and the bank statement. The cash book, that's the records of our company, of Bradley Enterprises, and the bank statement received from our financial provider. And we're going to reflect back on those 5 steps to help us produce that bank reconciliation. So step 1 is to agree the opening balances. Now we can clearly see that the opening balance in the cash book is very different to the opening balance in the bank statement. So we cannot proceed until we find the difference. Now if we take one away from the other, we are led to believe that the difference is 1,122, which conveniently is very close to the top of our bank statement, and we can see that in our paid in column. All that means is that was recognised on our cash book last period and is clearing the bank in this period. So when we clear off, or when we recognise the opening balances, we must recognise to do all of them, to do all 3, the opening balances plus that third adjustment. And then we proceed to step 2. Step 2 is ticking off the items that are in both. So if you've got a highlighter, that's the time to get it out. I'm going to work down the paid out column, the credit side of my cash book. It doesn't matter, it's whatever is comfortable to yourself. I can see an amount of 427 is in both. I can see an amount for 4,200 is in both. And also a final cheque for 1,062. And I've crossed those transactions off in both my bank statement and my cash book. When I glance down the debit side of my cash book to those three transactions of $1,200, $4,750 and $8,950, unfortunately none of those are in my paid in column. So I've completed step 1, I've agreed my opening balances. Step 2, I've reconciled and agreed both transactions that are in both documents. And step 3 is now I'm going to update my cash book with those transactions that appear on the bank statement but not yet into the cash book. I'm firstly going to record the £850 as a direct debit. I've got a further direct debit of £275, and you can see that whilst I'm doing that, I'm also just checking them off on the bank statement, just so when I come back to look at this, I know they've been dealt with. In the paid in column of my bank statement, I've got two amounts which need to be recorded on the debit side of my cash book for $2,486 and $4,110. At this point, if I look in my bank statement, all the items have had a tick next to, a line through, or a bar through. So everything in my bank statement has either naturally occurred in the cash book or I've put them there. I'm now going to complete step 4, and step 4 is to balance off the cash book. And we do this, as we've seen previously in the presentation, by finding the difference between the debit and the credit side. That difference is my balance carried down, and that difference is £15,812. Having inserted that balance carried down, I have then two totals that agree. That is step 4. And step 4 still highlights that I have a problem, because the balance carried down of £15,812 still doesn't agree with the closing balance of the bank statement, which is believed to be £1,672, so quite a significant difference. The bank reconciliation will hopefully reconcile that difference, and in doing so will identify those timing differences that are in the cash book but not yet in the bank statement. So we have completed the 4 steps leading up to the bank reconciliation, and the final step is to understand those differences. We were given a cash book and we've completed those 4 steps. We identified the opening balance. We agreed those transactions that appeared in both. We updated the cash book with those transactions that were in the bank statement but yet we weren't visible of yet. And we finally revised our balance carried down. We now need to understand why there's still a difference between the closing balance as per the bank statement, which is £1,672, and that of our cash book, which we calculated to be £15,812. The bank reconciliation helps us understand these differences, and these differences are driven by our timing differences. And you can see that I have 4 transactions on my cash book that have yet to be dealt with. 3 transactions on the debit side, 1 on the credit. Those are my timing differences. Those are going to help me agree the balances. I start the bank reconciliation as per the bank statement balance, the closing bank statement balance to be precise, and that's £1,672. I'm then going to take away from that any unpresented checks. Unpresented checks are payments that I've made as a business, I've recorded in my cash book but haven't yet cleared the bank. I only have one, that's on the credit side of the cash book for Cutler Limited for £760. I will do a little subtotal just for completeness, relatively straightforward in this example. However, you may have multiple transactions in your own business to deal with. I also need to take account of the outstanding lodgements, and these are transactions, these are receipts that have been received by my business. I've entered them into my cash book, but they haven't yet cleared the bank statement, but they will. Those outstanding lodgements refer to Wood & Sons, to Harris Brothers, and to Fellows Limited. And collectively, my outstanding lodgements agree to £14,900. The moment of truth is this balance. So I'm going to take my balance as per the bank statement. I'm going to deduct my unpresented checks of £760. I'm going to add my outstanding lodgements of 14,900, and that gives me a balance as per the cash book of £15,812. And that gives me confidence I've done things correctly, because the two closing balances agree on the two separate financial statements. The reconciliation gives you confidence that you're on top of your monetary transactions, there's no abnormal transactions occurring, everything is in order, and the only transactions that are missing from the bank statement are just timing differences, and they will clear in a future period. Those 5 steps are key to giving you structure, and as we said, structure gives you confidence, and confidence will give you marks in that assessment. And that concludes our review of cash books and bank reconciliations. I sincerely hope you found this video to be of interest. Thank you.